Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, January 22nd. Netflix announced blowout fourth quarter results after the bell yesterday. Trump announced massive investment in AI infrastructure in the US. The FTSE 100 advanced to an all-time high level while crude oil extended its losses. So tune in, we have a lot to talk about. So who wants to talk about something else than Trump? Netflix blew past the market expectations last quarter and closed the year on a very high note, guys. The company added 18.9 million new subscribers to its platform last quarter. That's its biggest ever quarterly jump in subscriptions, even above the pandemic months, mind you. The company added more than 41 million new subscribers over the course of last year and has now more than 300 million subscribers on its platform worldwide. And it's not even due to the pandemic or a forced stay at home or any temporary, situation like that. So that's very important to note. Is just that their strategic bet to stream major live sporting events like the NFL games, for example, and that boxing match between Mike Tyson and Jake Paul that got everybody talking around the world is simply paying off big time. Now, some say that the return of the Squid Game 2 may have helped boosting these numbers, but I really think that Netflix shiny numbers of last year and last quarter just come from a strategic boost from these live sport events than the Squid Game, in my opinion. And that actually tells that the upside potential for Netflix is open for more gains. Now, even more so, as the company is now planning to raise the price of its services in the US, in Canada, in Portugal, and in Argentina, somewhere between $1 to $1.50 on a monthly basis, depending on the plan, and that could add up to $1 billion of additional revenue to Netflix. So no wonder the company also raised its revenue outlook for this year to between $43.5 to $44.5 billion. So the share price jumped more than 14% in the after hours trading. That's a big fat number that we actually like to see after an earnings announcement from a big technology company. And the stock price will sure come this close and maybe break the $1,000 psychological level in the coming days, defying yesterday's shooting star pattern. Now, more good news on the wire for the technology lovers. Donald Trump, together with SoftBank and Oracle, he announced to invest as much as $500 billion in AI infrastructure in the next 4 years. An initial investment of around $100 billion will apparently focus on the data centers in Texas to provide the necessary storage and the necessary processing capabilities to handle these vast amounts of data efficiently. Then the broader so-called Stargate project, so this AI infrastructure project, will also include plans for electricity generation to support these energy-hungry data centers, which will also rely on nuclear energy to ensure a reliable and sustainable power supply for these energy-intensive operations of AI systems. So, Oracle jumped more than 7% on the news yesterday, while VanEck's uranium and nuclear ETF gained almost 5% at yesterday's trading session. And the news also boosted growth and productivity expectations for the US economy more than they actually fueled the ballooning debt worries for the US. So the US yields were, higher at yesterday's trading session, with the US 2-year yield settling around the 4.30% mark and still below last week's peak, about the 4.40% mark. Mind you, on the back of the slower than expected inflation figures announced in the US last week, but the equity indices were better bid yesterday despite these rising yields. The S&P 500 extended gains by 0.88% yesterday, having broken above its mid-December to mid-January downtrending channel top. The Nasdaq 100 was also up yesterday, but the technology-heavy index printed a doji day, hinting at some hesitation among the technology investors because Nvidia gained more than 2% yesterday on the support of AI news from the Trump government, but Apple's 3% dive due to an 18% fall in its China iPhone sales kept sentiment somehow mitigated. Note that the meltdown in the Chinese numbers from Apple resulted in a 5% slide in Apple's global iPhone sales. Ouch. But anyway, the US small and mid caps actually led the equity rally yesterday on hope that Trump's America First policies would boost domestic industries and their businesses, and that actually matched this year's expectation of a broadening equity rally beyond the technology stocks in the US and beyond the US borders as well. So beyond the US borders, the STOXX 600 index in Europe also shot up at yesterday's trading session and closed the session just a few points below an all-time high level, defying the morose growth outlook for the European economies. Now, note that here, the equity rally is mostly backed by the big valuation gap between the US and European equities that actually gets some investors looking for gems in the European markets. And in that gem context, well, Citigroup's top investment banker, he actually said that, well, you have gems of companies in Europe that they sometimes call, fasten your seatbelt, they call them good houses in bad neighborhoods. Rough, right? So the good news is that the valuation of good houses in bad neighborhoods could actually rise if the overall market conditions are correct. And right now we know that the European Central Bank's easing monetary policy stands to support the European economies, and these bets of convergence in the stock valuations with the US are supportive. But on the other hand, the valuations will certainly be capped by the external constraints like the lack of innovation in Europe and overly strict regulations as well. We also have political issues and uncertainty. So that's actually what worries me with the broader European companies and outlook for these companies. You really, really have to find those gems in Europe. And the same goes for the UK. The UK's FTSE 100 index actually printed its third record high in the past 3 sessions of trading, but the index is mostly fueled by global optimism and certainly also by weak pound that allows investors to buy the UK companies with international businesses and dollar revenues at cheaper prices. Now, happily for Rachel Reeves though, the UK's gilt yields came further down yesterday after the British jobs data showed that the wages in the UK grew more than expected by analysts, but the number of payroll people in the UK fell by 47,000. That's the biggest decline since late 2020 when the pandemic hit. And it's also a sign that the companies in the UK are serious about cutting their staff on the government's tax rising plans. So this actually leaves the Bank of England in a difficult place. The Bank of England is expected to deliver around 64 basis point interest rate cuts this year. So that basically reads as 225 basis point cuts and maybe a third interest rate cut this year. So cable gained yesterday on the back of a hotter than expected wages number from the UK and probably also on the back of these crowded US dollar longs that leads to a broad-based meltdown in the US dollar. So speaking of that, yesterday's doji candlestick on the US dollar index and trend and momentum indicators now hint that we could eventually see a deeper downside correction in the US dollar in the short run. So the dollar index could actually retreat a few pips before threatening to reverse the medium-term bullish bets. So technically speaking, the euro dollar, for example, will be remaining in the bearish trend unless it breaks above the 106 level, which is the major 38.2% Fibonacci retracement on September to January sell-off. while cable will remain in its own negative trend below the 126.50 mark, which is its own 38.2% Fibonacci retracement level on the September to January sell-off. So these currencies have room to recover before threatening important technical levels and the overall bearish trend against US dollar. Elsewhere, US crude remains under pressure but will likely seek support near the $75.20, $75.40 per barrel range, corresponding to the 200-day moving average and the major 38.2% Fibonacci retracement level that should, in theory, distinguish between the continuation of the latest positive trend and a medium-term bearish reversal. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your supportive and beautiful comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and as you know, please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.